Hello viewers, welcome to my channel. I'm Hasham. Now I'm going to start the new topic, that is chapter number 4 in financial management for MBAs. In first unit I have explained the introduction nature of financial management, where I have explained the meaning of the term financial management, what is the scope of financial management, what are the objectives of financial management. All these things I have explained in the first chapter. In second chapter, time value of money, meaning of time value of money, what is discounting, what is compounding, and so many problems we have done. Then chapter number 3, just now we have concluded, that is capital budgeting. The meaning and techniques of evaluating capital budgeting proposals. So many problems I have completed. Now this chapter number 4, this is regarding sources of long-term finance. So this chapter is very important from theoretical point of view. What I have observed, students will prefer only in doing the problems mechanically without understanding the concept, the meaning, the nature and consequences. They will not think. They just want to solve the problem, pass the examination. That is not the right way of acquiring education. If you want complete education, you will become knowledgeable. Then you must have the patience of listening the lecture, understanding. All these are practical things which are applicable in real businesses. So take it seriously. These theory are very important. Apart from this capital budgeting theory, time value of money theory, and financial management, all these theory I have explained. In the playlist you can find all the videos. So presently I am going to explain about the sources of long-term finance. What is finance, why finance is required, and what is the classification of long-term finance, what is the nature of each source of finance, I am going to explain in detail. So don't skip in between, watch the video till the end. Because ultimately in examination more chances are there in this unit. You may get a theory question. Problem is also there, but the chances of theory is more. So give more concentration on theory. So before proceeding, take the screenshot of the points which I have written on the board, then I'll explain. Now the chapter is sources of long-term finance. First of all, introduction and meaning. First of all, finance is the lifeblood of the business. Every business needs finance for production, for distribution, and all the activities providing the service. For every activity of the business, finance is required. It is the lifeblood. So it is necessary for the business to supply the funds to all the departments. Every department will cry for fund, whether it is production department, marketing department, research department, human resource, personal department. Any department requires funds. So from where to procure the funds? How to utilize the funds? Already we have discussed in previous chapter. Now procurement of funds. Every type of fund will have their own characteristic features, will have the advantages and limitations. So a business has to decide which source of finance is better for our business. We cannot say that one source of business is equally beneficial to all the businesses. No, every business will have different characteristics with different nature. So business has to evaluate which source is better for our business. So here I am going to explain you what is the nature of each type of long-term sources of funds. What are the benefits? What are the limitations? All these things I am going to explain. First of all, classification of funds. The classification of funds based on period. On different basis we are going to classify the long-term funds. Right? So based on period. First of all, we are deciding on the basis of period. On the basis of period, we divide the funds into long-term source of finance, medium-term source of finance, and short-term source of finance. So broadly on the basis of period, we are classifying into long-term, medium-term and short-term. So what is long-term source of finance? Every business will require a long-term source of finance, that is called permanent source of finance. This type of finance will be there with the company for a long period of time. That's why the fund is required for modernization, for expansion, for starting a new project or purchasing the fixed assets. So this type of requirement, we need long-term funds. The long-term means what? Normally many authors will say that long-term means a period of more than 10 years. That means the fund required is not to be repaid before 10 years. It will be there with the company for a long period beyond 10 years. But this is not the watertight compartment definition. It may differ from circumstance to circumstance. But normally we can say any fund which is there in the business for long period over 10 years is called long-term source of funds. And it is required in every business. Some funds are tied up, not required to be repaid. Just like a source of finance is required for starting a new project. The project will not be wind up. It's a long-term project. Modernization, expansion, starting up a new business. Some funds are required permanently. That's why this is called permanent funds, permanent source of finance. So normally from where we can get this long-term source of finance? Equity shares. What are equity shares? I'll discuss now, right? But right now remember what are the different sources of long-term finance. The long-term finance are from equity shares or from preference shares or retained earnings or debentures, long-term loans from banks, loan from financial institutions. So you have to remember these are the sources from which the business may get a long-term finance. The finance which is permanently there with the company for a long period beyond 10 years, right? So what is the meaning of equity, preference, debentures? I'll explain you later, right? In this video as well as in the coming video, I'm going to explain each and every point. Like equity shares, what are preference shares, what are retained earning, debentures, all these things I'm going to explain. Second one is medium-term source of finance. Normally, medium-term source of finance are those finance which are required beyond 1 year up to 5 years. That means the fund can be repaid over 1 year and before 5 years. And some authors in some companies globally it is said up to 10 years. That means medium-term means from over 1 year up to 10-year period is called medium-term finance. For every business, most of the business require medium-term finance also. Like for example, heavy advertisement have to be incurred when a new product is launched or when a new branch is opened. Heavy advertisement, huge advertisement is required. Lot of money is required. But this money has to be recovered back within a period of 10 years. In 10 years, we have to repay it back. Not beyond 10 years. Beyond 10 years, we'll go to long term. So up to 10 years, medium term finance. So what are the sources? Again, preference shares. Preference shares may be long term or may be medium term. Because redeemable preference shares are there. It can be redeemed in 10 years or 8 years or 6 years. Like that, it may become medium term. Similarly, debentures. Debentures will be repaid back. Either it may be repaid back after 10 years or before 10 years also. That's why debentures may occur in long term as well as short term. Next comes medium term loans from financial institutions. There are many financial institutions which will help. These are called development banks. These development banks will provide medium term loans to companies, to businesses. Next is public deposits and loan from commercial banks. These are few examples of taking the medium term finance. Next comes short term finance, short term source of finance. The finance which is required by the business, very short period, time to time it required, within 1 year. That means the amount has to be repaid within 1 year. Example of those, this short-term funds requirement is called working capital requirement. The fund required for day-to-day expenses. Like every month the business has to pay salaries, wages, rent, electricity bill, telephone bill. All these are the bills to be paid within 1 year. So some funds are required. Some money is required to meet all these day-to-day expenses, that is called short-term requirement of funds or working capital. From where do we get these funds for short-term purpose? Here examples: trade credit. Trade credit means buying the goods on credit. Just like when the business sells goods on credit, it may purchase the goods on credit. The goods are purchased, but amount has to be paid. So these are the funds which are supplied by the traders. That means the supplier has extended a period of payment. Secondly, short-term loans from commercial banks for working capital. Normally, most of the business will approach the commercial bank for working capital purpose, bank overdraft. Just like temporary, the bank needs, suppose 5 lakh rupees, which is to be repaid within 1 or 2 months or 3 months, within 1 year. That is called loan taken from commercial banks for working capital purpose. Then advances from customers. Some businesses will take advances from the customers in order to supply the goods. They will supply the goods afterwards, but before that they want advances from the customers. Then factoring. Factoring is also one of the new method of short-term finance. How? The trade receivable or the bills of the customers will be sold to a person, organization called factor. The factor will purchase all the trade receivables and make immediately the payment by taking their service charges. Example, in my business I have 10 lakh rupees of receivables from different customers. So these receivables I will sell to a factor. The factor will say 10 lakh rupees, I want 1 lakh rupees commission. So 1 lakh rupees we have to pay to the factor, and remaining 99% he will pay the cash immediately. So we are getting the money immediately from factor, and factor will collect all the money from trade receivables. Then bills discounted. If bills of exchange are there, the business will discount the bill with the banker and get immediately the money. This is also short-term source of finance. Commercial papers are also there right now. By selling commercial papers, they can be able to get the money for short-term period. So what I have explained here, based on period, we have divided the long-term the funds into long-term source of finance, medium-term source of finance, and short-term. And what are the method of raising the sources that I have explained. Now, based on ownership, the funds can be classified into owner's fund and borrowed fund. Owner's fund means the capital supplied by the owner. If the owner is a sole trader, the capital employed by sole trader is owner's fund. The capital employed by partners in a partnership firm is a owner's fund. In shareholders will purchase the shares. The share capital is the owner's fund. Whereas borrowed fund is the money which is borrowed from banks, from issuing debentures or from public deposits. These are the borrowed fund which the company has to repay along with interest. So these are the two types of funds on the basis of ownership. Now, based on source of generation, from where the funds are generated, internally or externally. So internal source of funds are the funds which are internally generated. Example, retained earnings. In the case of sole trader, the sole trader has earned the profit and he has not withdrawn the profit, but the profit is generated and reinvested in the business. Profits earned by the partners. The partners will not take all the profits, will not withdraw all the profits. Some profits will be retained in the business, right? So these are called internal. External sources of finance, the finance which is raised from outside sources, not internally generated. Like this, we have classified the sources of funds into three types. First one, according to period, long term, medium term, short term. According to ownership, owner's fund and borrowed fund. According to sources of generation, internally generated or externally generated. That's it. Now I am going to explain the overview of important sources of finance. We have seen here equity shares, preference share, retained earning, debentures, but you don't know the meaning. What do you mean by equity share? What do you mean by preference share? What are the characteristics? What are the advantages? What are the limitations? That you don't know. Now I'm going to explain. In examination, you may get a theory question. Explain the characteristics of equity shares and what are the advantages and limitations. Explain the meaning of the term preference shares, advantages and limitations. These type of questions are frequently asked. So I'm going to explain each of the source, right? First one, equity share capital. It is also called as ordinary share capital or common stock. This is the real capital of the company. This is a permanent source of capital of the company. The equity share capital will stay till the end of the company, till the company is wound up. Throughout the life of the company, this capital will be there with the company. The owners of equity are called equity shareholders. They are the real owners of the company. They will take all the risk and they will get all the reward from the business. The equity shareholders will have the right of voting in the management of the business. They have a voice in the management of the business. So first of all, equity share capital. It is that part of capital which is permanently there with the business. Bears the complete risk. That means the equity shareholders will take the complete risk and reward of the company. Risk in the sense, if the company incurs loss, they will bear the loss. If the company sink, their money invested in the company will also sink. They will not get anything. But reward, when the company earns huge profit, they will get huge dividend. So that's why the first character, they have the higher risk and higher return. It is permanent or perpetual in nature. So the first characteristic is bears the complete risk and reward. Second, it is permanent and perpetual in nature. Permanent means the company is not bound to return it back. Suppose if the shareholder dies, automatically his shares will be transferred to their legal heirs. That means the share capital will always be there, whether the shareholders will come and go. There may be change in the shareholders. That's why this capital is called permanent and perpetual. Then third one, residual capital. Residual capital means when the company winds up, the capital has to be returned to other shareholders like preference shareholders and debentures. Everybody's liability will be settled. After that, if anything remains, that goes to equity share capital. Carries voting right. Another characteristic of this equity is they are having the voting right. They can elect the directors. They have the voting right to vote for directors. For important resolutions, they have they have the right to vote. So voting power is there with equity shareholders. Then carries no security. Whereas preference shares or debentures, they will carry some security against the assets of the company. But equity shareholder does not have any security on the assets of the business. Lastly, shares are freely transferable. The equity shares are freely transferable in the secondary market. Once the company issues the shares in primary market, the shares are issued to the shareholders. Later on, the shareholders, if they want to transfer, they can transfer it freely at the secondary market in the stock exchange. So these are the characteristic features of equity. From company's point of view, what are the advantages and limitations of equity? First advantage is meets the permanent financial requirement. The equity share capital is not required to be returned back. So it's a permanent source of capital. As long as the company is there, the share capital, the equity share capital will also be there. So that's why it is called permanent share capital. Second one, ideal for startup business. When a business is newly started, equity share capital is the main source of finance. Whereas when the company is newly started, banker will come forward, no debentures can be issued. So whenever the company is newly started, it should depend on equity share capital. No fixed payment required. That means the dividend. The dividend to shareholders depends on the profitability of the business. If there is no profit, there is no obligation to pay the dividend to shareholders. That is also advantage to the company. Profit raha to dividend pay karenge, no profit, no dividend. Then most suitable for long gestation period business. Some businesses are there where gestation period is long. That means when a business is newly started, it will take more time to become profitable. It will take a lot of time. Gestation period is more. So for those businesses, equity capital is better because no need to pay the return, no need to pay the dividend, right? These are the benefits. But from company point of view, there are some limitations or drawbacks of equity capital. What is the first drawback? Cannot be redeemed, so danger of overcapitalization. Once the shares are issued, it cannot be redeemed, it cannot be taken back. So there is a possibility of overcapitalization. Sometimes the business activity has been reduced. So compared to business activity, capital is more, but capital cannot be returned. That is called overcapitalization. When a business is overcapitalized, the profitability will come down because business should need only that much capital which is required. If more capital is applied, then definitely, just like in case of a plant, when the plant is small, you are putting the water. So sufficient water should be applied. But if you give overwatering, if you make overwatering, then what will happen? The plant will die. Similarly, when a business requires funds, only adequate funds should be supplied. If over funds are there, then it is called overcapitalized. The profitability will come down. So this is the problem. Equity holders expect higher return. Compared to preference shareholders or debenture holders, the expectation of equity shareholders is more. They expect more dividend. Why they are expecting more dividend? Because they are taking more risk. Higher the risk, higher the return. Why they are taking the risk? Because the company has to pay interest on debenture holders, dividend to preference shareholders. After that, if any residual profit is left, that residual profit will only pay to equity. They are the last claimant of return. That's why the risk is more, so their expectation is also more. So from company's point of view, more dividend has to be paid. That's the limitation. Then cost of capital is higher comparatively. When the company compares the cost of capital, highest cost of capital is equity capital. Highest cost of capital is equity capital, right? Then debentures. Debentures, the cost of rate of interest is lower. Preference, the rate of preference dividend is lower, whereas this is higher. Cost of issuing is also too high. When the company issues the equity shares, cost of flotation will be incurred. Flotation cost will be there. So more flotation cost when equity shares are issued compared to other sources of funds. Then each equity share dilutes the control of existing shareholders. Whenever company issues more and more equity shares, the present equity shareholders' control will get diluted. For example, presently the company is having 1 lakh shares. So every shareholder is having good control over the business. That means the voting power is more. But when 1 lakh more shares are issued, then the public will have 2 lakh shares. Then the controlling interest will come down. The voting power will come down. Next one is dividend distributed to shareholders are not tax deductible. See here, when the company raises the funds through debentures, interest paid on debenture is tax deductible. While computing income tax, interest paid on debenture is deductible expenditure. Whereas when dividend is paid on equity shareholders, the dividend paid is not deductible. When the dividend is not deductible, the income will be more. The profit shown will be more. When profit shown is more, the tax liability will also be more. That's the disadvantage of the equity shares. So what I have explained about the meaning of the term equity, advantages and limitations. Now I am going to explain the next type of shares called preference shares. When the company issues preference shares, the people who buy preference shares, they will become preference shareholders. The preference shareholders will have a preferential right to get the dividend or to return of capital at the time of winding up of the business. The two preferential rights preference shareholders will get. The first right, they should get the dividend before any dividend is paid to equity shareholders. Second right, at the time of winding up of the company, the preference capital should be first returned. After returning preferential capital, if any amount is there, that will be paid to equity shareholders, right? These two rights are there with preference, but they are having some negative points also. So, have preference over equity share capital in respect of dividend. So, first point, they are having preferential right to get the dividend and to return of capital at the time of winding up. Second point, not permanent. Compared to equity, it is not permanent because it is redeemable. The preference shares are redeemable. According to present Indian law, no company can issue irredeemable preference shares, and the redemption period should not be more than 20 years. That means any company can issue preference shares which should be redeemable below 20 years. So it is not permanent. Before 20 years, we have to return it back. So it is not as permanent as equity. Next, entitled to fixed rate of dividend. The rate of dividend on preference shares is fixed at the time of issue itself. The company will declare these preference shares will carry a dividend of 15%. Example. So every year 15% only rate of dividend is applied. Neither more nor less. Fixed rate of dividend. Whereas equity shareholders, the rate of dividend is not fixed. It will depend on two items. The rate of preference dividend is fixed. Whereas in case of equity shares, the rate of dividend on equity share is not fixed. It may fluctuate. That means it depends on two things. The first is profitability. If the company is having huge profit, they can declare huge dividend. Secondly, it depends on the discretion of the board of directors. That means decision of the board of directors how much rate to be declared. So these two things, dividend is based in case of equity. But here in case of preference, the rate of dividend is fixed. Next, no obligation to pay dividend by the company. That means the rate of dividend is fixed, but it is not obligatory. That means if the company is having the profit, then only it can pay the dividend to preference shareholders also. That means if the company is incurring the loss, then it is not an obligation on the company to pay dividend to preference shareholders. Right? Does not carry voting right. Equity shareholders will carry voting right, will have the voting right, but preference shareholders will not have any voting right in giving the vote regarding the election of directors or important resolutions. They don't have any right to vote. These are the characteristic features. Now, advantages of preference shares. Many advantages and limitations are there. The first advantage, part of net worth and therefore reduces the debt equity ratio. When we calculate net worth, it includes equity as well as preference. That means the debt equity ratio will not increase by issuing preference shares. When debt equity ratio is not increased, then borrowing capacity will not get affected. The company's borrowing capacity will not get affected by issuing preference shares because it's a part of net worth. Secondly, does not lead to dilution in control of existing shareholders. When new shares are issued, if new equity shares are issued, then the existing shareholders' control will get diluted. But when preference shares are issued, the existing equity shareholders' control will not get diluted. That means after issuing preference shares, the control of existing equity shareholders will not get affected. Third one, does not require any charge or mortgage on the assets of the company. In case of debentures or any loan, it will create a charge against the assets of the business. Example, when debentures are issued, it is a secured debenture, security provided on the assets of the business. If the company fails to pay interest or fail to pay back the debenture amount, the debenture holder will have the right of charge on the assets. But preference shareholders and equity shareholders will not have any charge on the assets of the company. Then these are the advantages. And compared to equity, the cost of preference capital is low. Another advantage. कंपनी को और एक एडवांटेज ये है कि द कॉस्ट ऑफ कैपिटल ऑफ प्रेफरेंस इज नॉर्मली लोअर देन द कॉस्ट ऑफ कैपिटल ऑफ इक्विटी. एक कंपनी एग्जांपल, एक कंपनी में डिक्लेयर 30% of the average rate of dividend on equity, whereas preference share of dividend is only 20%. So compared to equity, the rate of dividend on preference is lower, and that's a benefit to the company. Cost of capital is lower. Next one is the rate of preference dividend is fixed, hence even if the profit is more, same preference dividend should be paid. Another advantage to the company. Even if the company profit is huge, they will pay only the fixed rate of dividend to preference shareholders. The rate of dividend will not increase. So that's advantage to the company. Only fixed rate of dividend they are paying. But what are the limitations of preference shares? Disadvantages, drawbacks of preference shares. Arrears of preference dividend may accumulate and make a business to pay to the company, burden to the company. In case of cumulative preference shares, then what will happen? If in any 1 year dividend is not paid, that dividend will get accumulated and should be paid in the next year. That means it will become a burden to the company. If the company incur loss in 1 year, no dividend was paid to preference. Second year again loss, no dividend was paid to preference. Third year huge profit, the company has to pay 2 years arrears of dividend and current year dividend. That means it's a burden to the company because arrears of dividend also have to be paid. In case of equity, no arrears of dividend. If a company does not pay dividend in a particular year, that year is lapsed. No dividend will be paid in future. But here in case of preference, there is an accumulation of dividend. It's a burden to the company. Next is compared to debenture, the cost of preference capital is high. If you compare the preference share capital with equity capital, the cost of preference is lower. That's a benefit. But if you compare the interest rate on debentures and dividend on preference, the preference dividend is higher. Preference dividend is higher than the rate of interest on debentures. So from debenture point of view, this is a costly. Then dividend on preference capital is not tax deductible, just like equity. When the company pays dividend on equity or dividend on preference capital, it is not a deductible expenditure from income tax point of view. That means when we are not charging as an expenditure, our profit will be more. When profit is more, we are paying more tax. So our tax liability will increase if we issue preference shares. If we issue debentures, then interest paid on debenture is tax deductible. In that case, you can charge it as an expense and your profit will come down and your tax liability will also be decreased. From income tax point of view, it is better to give debentures, to issue debentures rather than equity and preference. So preference shares usually do not carry voting rights, so preference shares have no say in the management. The preference shareholders will not carry any voting right? They will not have any say in the management. So these are few limitations of preference share capital. Lastly, classification of preference shares. Preference shares are classified into different categories like cumulative and non-cumulative. Cumulative preference shares means when in any year the dividend is not paid, the arrears of dividend will have to be paid in future. अगर एक साल डिविडेंड नहीं पे करे तो वो डिविडेंड एक्यूमुलेट होता जाएगा, फिर फ्यूचर में उसको पे करना पड़ेगा. दैट इज क्यूमुलेटिव प्रेफरेंस शेयर्स. नॉन क्यूमुलेटिव प्रेफरेंस शेयर्स, अगर कोई ईयर में प्रेफरेंस शेयर नहीं डिविडेंड नहीं पे करे तो वो ईयर लैप्स, इट विल नॉट गेट एक्यूमुलेटेड. सो टू टाइप्स, क्यूमुलेटिव एंड नॉन क्यूमुलेटिव. The next one is participating and non-participating preference shares. Participating preference shares means profit left, any profit left after paying equity shareholders dividend. Then in that profit, preference shareholders will also have the right. Normally they don't have right, but if the preference shares have written that participating preference shares, so they are participating in the excess profit left after paying equity dividend. That is called participating. And other one is non-participating. In non-participating, the preference shares will not have any right to participate in the surplus profit left after paying equity dividend. If nothing is there, we always assume that preference shares are non-participating preference shares. Last one is convertible and non-convertible preference shares. Convertible preference shares are those preference shares where it is written by the company that these preference shares can be converted into equity shares. Converted into equity shares, either optionally or mandatory after a period of time. Just like at the time of issue, the company has specified these preference shares can be converted into equity shares after a period of 5 years. Mandatory or optionally. If it is optionally, the shareholder have to decide whether he should get converted or not. If it is mandatory, compulsory the preference shares have to be converted into equity. But non-convertible preference shares, it will never be converted into equity shares. It will always remain preference shares. Next is redeemable and irredeemable. Redeemable means which can be taken back. The company will specify that these preference shares will be taken back by the company after a period of 5 years or after a period of 10 years. So as soon as 10 years are completed, the preference shareholders have to return back the shares to the company will repay the amount. This is called redeemable. Irredeemable preference shares, the company will not say anything. That means the shares will always be there with the shareholders. The company will not take back. That is called irredeemable. But according to the present law, no company in India can issue irredeemable preference shares. And no preference shares can be issued which can be redeemable after 20 years. That is the present law. That means the company can issue preference shares within a redeemable period of 20 years, below 20 years, not above 20 years. That is the present law. So in this video, I have explained you about the introduction and meaning of sources of finance. And we have classified the long-term source of finance into based on the period, then based on ownership and based on generation. Then I have explained about meaning of equity shares, advantages and limitations, then meaning of preference shares, advantages and limitations, and lastly classification of preference shares. So if you want to get confidence on this topic, watch the video twice, thrice. Remember, it's very important from examination point of view. Very frequently they will ask these points. If you listen, if you watch the lecture for 2-3 times, definitely you can be able to get the points and you can write in examination with full confidence. So I'll continue in the next video. Before that, I advise you, please give in the comment from where you are watching the video, because in more than 20 countries my channel is being run. I'm getting the views from different countries. I want to know from which country you are watching, which university you belong, and what are your comments. Give your comments, and apart from that, give a like to the video, share my channel, and subscribe if you have not yet subscribed. Inshallah, we'll continue the next topic in the next video.